Over 22 million people in the UK have money in premium bonds. That's roughly 1 in 3 adults. That's the country's most single popular saving product. And yet most of these 22 million people are quietly being ripped off by a number they don't really understand. Today I'm going to break down exactly how premium bonds work, what the numbers actually say about how good they are, who they generally work for, and crucially, who they are really not for. Because the honest truth is, for a bunch of people holding them, premium bonds are not really a good deal, even though they seem like it, potentially. Let's get into it. So I think it's useful to just do a quick explainer for anyone new to this. Premium bonds are a savings product run by NS&I, the National Savings and Investments, which is backed by the UK government. When you put money into premium bonds, you're not actually earning any interest. Instead, every £1 you hold becomes one bond, and each bond gets entered into a monthly prize draw. You can win anywhere from £25 up to £1 million tax-free, and your money is always 100% safe. You can get it back whenever you want, relatively quickly. On paper, this sounds brilliant, and that's probably why there's so many people invested in it, to be honest. Tax-free prizes that is perfectly safe. But here's where it gets interesting, and where most people's understanding kind of doesn't really work anymore. NSI advertise what they call the prize fund rate. As of April 2026, that rate is now going to be 3.3%. And people hear 3.3%, great, that's what I'll earn as a return on my investment, because that's how other kind of cash savings accounts work. But that's not how it works in this case for premium bonds. And understanding why is the entire point of this video. Before we get into the maths fully, let's note something important. This 3.3% is not just low, it's at its lowest point in years of premium bonds, and it's got there through a series of cuts. The prize fund rate hit a peak around 4.65% back in September 2023. Savers were reasonably happy with that. That was a pretty good savings account, even compared to other investments, cash-like investments. Since then, NSI has cut and cut and cut again. By January 2025, it was 4%. By August 25, it was 3.6%. And as of April 26, just this month, it's going to be dropped to 3.3%. While the odds of any individual winning have lengthened from 1 in 22,000 to 1 in 23,000 at that time, in total around 22 million has been stripped out of the monthly prize pool. That's roughly 300,000 fewer prizes being made each month compared to 2023. NS&I say this reflects changes in the wider savings market, and look, that's probably fair enough. Saving rates have come down generally. But here's the thing, easy access cash ISAs are still paying around 4.4% right now. So premium bonds aren't just lower than their own peak, they're currently lower than what you could potentially get in another deal, in a cash ISA for example. So keep that number in mind. Right, here's the bit most people need to really focus on. The 3.3% prize fund rate is a mean average. And for most holders, the mean is almost meaningless. Let me explain what that actually means. NSI takes the entire prize fund, divides it by the total value of all the bonds in existence, and arrives at 3.3% as an average rate of return. So if you average out every single holder's return, you'd get around 3.3%. That number is technically accurate, but it's also deeply misleading for the average person, especially if you don't have the maximum amount in premium bonds. Here's why. The prize pool is just massively distorted by these massive jackpots. So there's 2 £1 million prizes every single month. Those 2 winners drag the mean up for everyone. Meanwhile, 75% of all prizes just paid out £25. The distribution, therefore, is kind of brutally skewed. The numbers that actually matter for you isn't the mean, it's probably the median, the most likely outcome. And for small holders, that median return is actually kind of closer to zero. So let me give you some kind of example numbers here, because this is where it gets really obvious. If you had 1,000 premium bonds, there's roughly a 73% chance that you win absolutely nothing that year. And if you do win, it's most likely to be a £25 prize. So you're statistically more likely to actually get more money from a cash ISA, £45 for example, while you get nothing at all over that time period. If you have 5,000, you've got around a 53% chance of winning nothing this year. Coin flip, odds of getting anything back. And if you have 10,000, it's around a 30% chance of nothing. Better, but still not great. You'd have to get all the way up to around £50,000, the maximum holding you're allowed, before it kind of generally starts working for you in a better way. And you get something you're most likely to win something every month. And here's the other thing no one talks about, the time it takes to get your first win. With £1,000 in bonds, you need to win, statistically speaking, around 13 years before you have a 50-50 chance of winning even once. 13 years of nothing with £500. That's not great savings. That's gambling, essentially. So compare that to a cash ISA that might pay 4.5%, and your £1,000 is earning £45 guaranteed that year in your account every year, or at least until the rates goes down. But then any gain you get on top of that gain is compounding that gain you got. So over time, it's actually increasing, irrespective of how much money you're putting into that. That's less important in premium bonds because they're not a compounding investment necessarily. And let's talk about those jackpots for a moment, because I know some of you are thinking, yes, but there's a chance I'll win £1 million. There is, technically, but the odds of any single £1 bond winning the 1 million jackpot are approximately 49 billion to 1. So even if you hold the full £50,000, you have 50,000 bonds in the draw, your odds are still roughly 1 million to 1 for the jackpot in any given month. For context, you're more likely to be struck by lightning. The jackpot is basically a marketing device. It's what the premium bonds feel exciting than what they actually are. For most people, holding a few £1,000s or even £10,000, you're most likely to win something around £25, which actually makes your real rate of return not very close to even the 3.3% at all. I think it's really important just to think about the other savings products you could be investing in if you want a cash-like savings account that can kind of is safe but gets you a rate of return. So we've got premium bonds, 3.3% fund rate at the moment, which might go down in future. Yes, your capital is 100% safe, and any returns you get are tax-free. It's fully government-backed, and your maximum holding of £50,000. But your return is a lottery. There's no guarantee you win or get your money back on that investment. So you could have £50,000 in there and technically win zero for 5 years, which actually in real terms means you're losing a lot of money because of inflation. The cash ISA, so currently you get them 4%, 4.5%, and your capital's safe generally under up to £120,000 under FSCS protections. If it's in an ISA, your returns are still tax-free, and you can put around £20,000 into that every year, although that's decreasing to £12,000 for cash ISA specifically from April. So in terms of return, you're beating the premium bonds because you're getting a guaranteed rate of return that's actually higher. And you can put in, while you can't put in as much money, you can still put in a reasonably large sum of money for most people. And so most people are going to struggle to kind of even reach that £12,000 limit on the cash ISA. And therefore it doesn't really matter if you're not constrained by that limit whether or not you should have the money in premium bonds or the cash ISA. I would generally say cash ISA is probably safer in terms of meaning you can guarantee an actual rate of return. If you have, too much money to put into your cash ISA, then a premium bonds does become more of an alternative savings account that would be potentially of interesting then. And the other one is, if you are interested to take a bit more risk, it's probably worthwhile investing in the stocks and shares ISA, which you could put in an additional £8,000 on top of that £12,000 or the whole £20,000 of your ISA allowance. And historically, these stocks and shares, if you're investing kind of diversified and globally, you might be able to get a 7, 8, 9% return in investment. It's higher risk, but your capital can work a lot harder for you and compound over time, meaning that if you're investing for 5, 10 years, it's probably a better investment for you because that money can actually beat inflation. Whereas if you're investing for less than 5 years, a cash ISA or the premium bonds would potentially be more interesting. But it depends on your personal circumstances and risk appetite. If you put £10,000 in a stocks and share ISA for around 25 years, for example, you might have around £90,000 today based on historical average returns. The same £10,000 in premium bonds could potentially get to around £22,000, and cash ISA might be around £30,000, but it really depends on the rate of returns from all of them. So that's an example of the three options you might have if you've got spare cash that you want to invest in something. If you've got ISA allowance left, then the cash ISA potentially works for you if you can get a good rate. If you want to invest longer term, then it's probably worth putting something in the global diversified stock market and leaving it there. But if you don't have the risk appetite for that, or you've maximised both of those, then premium bonds potentially is another savings product because you can put £50,000 in there and it's cash free. But let me go into a bit more detail about who premium bonds actually could work for, because there are some cases. Primarily if you're a higher rate or additional rate taxpayer who's exhausted your personal savings allowance. So if you're a higher rate taxpayer, you might only get £500 tax-free interest allowance per year, and additional rate taxpayers get zero. So if you gain any kind of interest on your cash in a non-ISA environment, so in a general investing account or a savings account, you're immediately going to have to start paying tax, or after £500 of that, on that. And you don't really want to do that if you've got a 40 or 45% tax rate. It essentially means you've got to be earning a higher rate of return to counteract that tax that you'll be paying. So you'd have to be earning a 5.5% return on your cash compared to 3.3% tax-free return. That's a pretty meaningful advantage. So premium bonds make sense if you're a high rate taxpayer or extra high rate taxpayer and you've maximised your ISA allowance. If you haven't maximised your ISA allowance, then it's probably still worth putting money in that. They also make sense if you've got enough cash to kind of almost get it to that £50 maximum. At that level, the mathematics finally kind of start working for you. You're most likely to win multiple prizes per month, and those prizes, have a potential chance of being a higher return, and that means your actual rate of return is much more closely tied to kind of what the advertised rate is going to be. It's still not going to be great, but it is tax-free, and there is that potential you could win that £1 million, which is not necessarily bad. They also make sense because they are very liquid, they're backed by the government, your money is not going to go anywhere. If you want a very, very safe savings account, then you could put money in there, and it makes sense for that reason. It is backed 100% by the government. And I think to sum it up, premium bonds are fine. Like, there are better investments out there if you want to maximize your money, and I think it's a useful thing to kind of have if you want to have a bit of fun with the return, but for long term. And you know, I personally have had some money in there as a kind of like part of my emergency fund, where I need just kind of liquid cash that I can access quite easily, but it gives you a bit of potential that you might get a return on it. So that's what I've personally used it for. But again, if you are investing or want that money for the longer term and to actually build wealth for you, it's probably better to invest that money and not just leave it in premium bonds. And I think that's the thing, is at the moment there's millions of people with them, when actually they could be using that money they could have that money better invested in a cash ISA or in a stocks and shares ISA at the same time. And I think that's the big point I want to hammer home. Make sure if you've got premium bonds that you've got them for the right reasons, and not just because you think you can win that £1 million, because you're probably not going to, statistically speaking. And so make sure your money is used to work for you in a better way. And I think that's why, for some people, you shouldn't have them. If you've got a small holding, let's say under £10,000, the maths is really not working for you. The most likely outcome, you know, is probably you're not going to get anything from that year. Whereas a cash ISA will almost certainly outperform what you're going to get from that. And you can guarantee that you'll get a certain amount of money each year. If you're a basic rate taxpayer within your personal savings allowance, then you could just invest money in the cash ISA and then leave some money to get interest as well in a general account. That's fine. You don't really have to worry about that. And again, as I keep saying, if you've got a longer time horizon, like 5 years or more, you should really be investing in a stocks and shares ISA if you've got spare money lying around. But always make sure you've got an emergency fund of 3 to 6 months in cash available to you. And you can put that in premium bonds or cash ISA if you want. Let's sum it up. Premium bonds aren't really a savings account that dresses up like a lottery. They're more like a lottery that is also a savings account. So they're a lottery first. Just be aware of that. They're safe and tax-free. So, you know, it's honestly better if you want a lottery-like scenario, probably put money in a premium bonds account than buy a lottery ticket, for example, because your money's not going anywhere. But for the average person, if you only got £5,000-10,000 of savings, it's probably better to put it in a cash ISA, or even better in a stocks and shares ISA if you've got a longer time horizon. It doesn't make premium bonds bad. You just got a specific kind of person who should be using them. Where at the moment, I feel like a lot of people are using them when they have better options available to them. I hope that's come across in the video. I think as their rate is going lower and lower, they become less and less good to keep your money in. And I think, as with anything, there's a time where they were good. Back when it was 4.6% was quite tempting. But as they go lower and lower and lower, they're of less interest, and you potentially get better deals with cash ISAs out there. So just be aware of that. I think people don't really move their money around from their cash ISAs to their premium bonds and back and forth, but there's nothing stopping you doing that. If you found this video, please like and subscribe. I cover all this kind of stuff on my channel. Leave a comment if you want something specifically to analyse and kind of discuss in detail. But thanks for watching. I'll see you next time.